Question number 23. A company is considering hedging its foreign exchange risk. It has made a purchase on 1st of July 2016 for which it has to make a payment of $60,000 on 31st of December 16, right? Payment of $60,000 to be made on December 16th. The present exchange rate is $1 is equal to rupee 65. This is the spot rate, okay, dollar quote. It can purchase forward at $1 is equal to 64, the forward rate. The company will have to make an upfront premium at the rate of 2% of the forward amount purchased. The premium is 2% of forward amount purchase. It means like 60,000 into this 64, right? Because this is the forward rate. The cost of the funds to the company is 12% per annum. Okay, now why is this cost to the funds is given to us? Think about it. See, the upfront premium, name itself suggests that the premium has to be paid right now on spot upfront. By default, we are assuming the company does not have any funds. The company will borrow that funds to pay that particular premium of 2% on this forward amount. At the forward rate. Okay, so for that funds which are borrowed, for that premium, for that funds that are borrowed on that 12% per annum. So on the equivalent, you have to make the interest cost, right? Calculate the interest cost. Further, in the following situations, compute the profit and loss to the company if it hedges its foreign exchange risk with the exchange rate on December 16 turn out as 68, 62, 70 and 65. These are the actual, or these are not the actual. Yeah, these are the actual. Like they will turn out either 68, either 62. So individually we have to do. If it turns out to be 68, actual rate turns out to be 68, then what is the profit or loss to the company? Okay, if it hedges the position. And the hedge rate is already given to us at 64. Okay, the spot is 65. Right. So let's calculate the premium amount. Okay. See, the premium has to be paid on this particular amount, which is $60,000. The rate is 64, correct? Because clearly they've said 2% of the forward amount purchase, right? And 2% of that. So see here, I've already solved the question to save some time. Premium paid today, very important today, is 2%. So 2% of what? 60,000 is the base amount which you have to actually pay, make a payment on December, but at the forward rate. So that forward rate is 64 rupee by dollar. Dollar goes, I'm left with rupee equivalent. Okay, this amount comes to something which I have not calculated. Wait, 64 into 60,000 into 2% would give me 76,800. And on this, now as I already mentioned earlier, to pay this particular funds, that is this premium, upfront premium, you have to borrow. Okay, the importer has to borrow, the company that is there has to borrow from the bank, and the funds, the cost of that particular fund is 12% to the company. Okay, I'm borrowing only how much for how many months actually? Calculate that. Today I'm standing is July and December full month. Up to that I have to borrow the funds. So July, August, September, October, November, December, 6 months, 6 full months. So I have to pay an interest on this amount at the rate of 12% for 6 months, right? So I've added this. This is basically 76,800 into 12% into 6 by 12. Okay, this is the cost of funds to the company. I hope you are able to understand what I'm doing right now. Okay, so into 12% divided by 2 directly. This gives me 4608 M plus MRC, it's 81,408. Yes. So this is the premium amount, which is 76,800 plus the interest cost. In order to borrow these particular funds of 76,800, I have to pay an interest cost of 4608. So my total cost for this upfront premium is the premium and the interest cost comes up to 81,408. Okay, and what is this? This is dollar or rupees? Dollar goes, this is rupee. This entire cost is in rupee. Okay, are you able to understand this part? So now this is fixed because this is upfront. In any situation, in any of these situations, whether be the rate 68, 62, 70 or 65, you have to pay this amount today. Okay. Further, let's talk about the profit and loss. Okay, that's what they are asking. Now, see here, we'll take the first scenario, which is 68. If the actual rate actual exchange rate on 31st of December turns out to be 68, then what? See, I have purchased the forward contract at 64. Okay, I've bought the forward contract. So now this rate turns out to be 68. I bought the dollars at 64 and I'm selling them. See, because in when you're hedging, you take the opposite position, right? So I'm selling that at selling them at 68. So clearly it's a profit. Buying low, selling high, right? So it's a profit. I've already calculated this. This is 2,40,000. Now if you want to know how this came, I will do it again. 60,000 was your base price. Okay, this is the amount that you have to pay. See, you as a company has to pay. For example, you are an importer in this case. Let's assume that, because you have to make the payment on December. How much? 31st December, right? 31st December 2016. You have to make some payments. So for that, what you did was, standing today, you booked a forward contract for 6 months, right, at the rate of 64. Since you have to make a payment, you booked a forward contract of buy dollar, and your exposure was also dollar 60,000. Second, this is $60. So you are booking a forward contract of buy dollar at 64, right? $1 is equal to 64, and now the rate turns out to be 68. So in order to settle the contract, you will sell this. See, in hedge you have to take the opposite position. So you are selling at today's rate, turns out to be 68. So there is a clear profit, right, of rupee 4 per dollar, per every dollar. So like that you have $60,000. So how many profit? Simple calculation into rupee by dollar. This is 68 minus 64. When you calculate this, I'm sure this will come out to 2,40,000. Okay, it's okay, like 6 4 is 24, so 2,40,000. But what? Dollar goes, this is also rupee. This is your profit. But is this your inflow? No, because there was an outflow that we already calculated, which was the premium amount plus the interest. Okay, premium plus the cost to get that funds of the premium. So that was 81,408. 81,408. This is your outflow. Okay, so you have to subtract this. Minus 240 would give me 158,592. What? All this is in rupees. Okay, so this is your net gain, you could say, in the first scenario where the exchange rate turns out to be 68. Correct? This is your final answer. Similarly, you will do in all these scenarios. Now I'll orally do this. See, if the exchange rate turns out to be 62, then what will happen? Gain or loss? See, you bought the contract. You bought a forward contract at 64. So buy 64. I'll write it here. See, buy at 64 and sell the opposite at 62. Clearly a loss. You are buying at a higher price. You are selling at a lower price. So there is a loss of 2 per how many dollars? Your exposure is $60,000. So 2 into 60, how much is 1,20,000? So 120 would be your total loss, rupee. Okay, but this is not your only loss. Like, along with this, there is an outflow of this. Do not forget this. Okay, this particular premium is in all cases, because these are scenarios given to you. Okay, different scenarios, rates which will occur on the final date, payment date. So then 81,408 will again be added here. So 81,408. So your final would be, see, 1,20,000 plus 81,408 would give me 201,408. This is your final outflow in the second case. See, we'll check the answer here. Wait. Just a minute. Yeah, see, the first case scenario is 158,592. Another case was 201,408. I think I'm correct. 158,592. And the next one was 201,408, correct. And your premium plus interest was 81,408, which will be in all scenarios. See this, correct? I'll reduce the highlighter level because then you cannot see anything. Okay, are you able to understand? So in this particular case, the present exchange rate is 65. $1 is equal to 65 rupees is of no use, right? So in all case scenario, you have to find this answer individually. Correct? Okay, thank you. Bye bye.